5 banks control half of all banking profits in America. They represent 0.1% of all banks. Every time a small bank disappears, they get stronger, and you get poorer. Want to know how much poorer? The big banks charge you up to 10 percentage points more in interest than community banks did. Let me be clear about what's happening here. This isn't some natural evolution where technology makes branch banking obsolete and consumers freely choose digital alternatives. This is engineered consolidation, a systematic transfer of wealth from your community to a handful of financial oligopolies wrapped in the language of innovation and efficiency. The numbers tell you everything you need to know. Last year, banks closed over 400 branches in a single quarter, the highest rate since early 2022. That's not a gradual shift, that's acceleration. And the merger activity driving it? Deal values tripled in 2024, hitting $12.5 billion compared to just over $4 billion the year before. Small banks aren't slowly fading away. They are being swallowed whole. Now, who's doing the swallowing? JP Morgan Chase controls nearly 12% of all deposits in America. Bank of America controls another 11%. Add in Wells Fargo, Citigroup, and US Bank, and you've got 5 institutions, 5, that capture almost half of all banking profits in this country. They represent 0.1% of all banks. Think about that concentration. 0.1% controlling half the profits. That's not a competitive market. That's an oligopoly. And here's what that oligopoly costs you directly. When you borrow money from one of these giants, you pay a premium for the privilege. The 25 largest credit card issuers, dominated by these same mega banks, charge interest rates 8 to 10 percentage points higher than small and medium-sized banks. 8 to 10 points. On a $10,000 balance, that's an extra $800 to $1,000 a year extracted from your pocket and deposited straight into their shareholders' accounts. Multiply that across millions of borrowers, and you're looking at tens of billions in wealth transfer annually, from you to them, facilitated by the elimination of the community banks that used to offer you better terms. But the banks have a story to tell you about why this is all perfectly reasonable. They'll say, customers prefer digital banking now. Foot traffic is down. Branches are expensive to maintain. It's just the market working, right? Except the market isn't working. It's being worked. Yes, some people use digital banking. But here's what they don't mention. 45% of Americans still conduct banking in person. 10 billion ATM transactions happen every year. The decline in branch visits isn't a revolution. It's a slow drift. And even that drift is partly created by the banks themselves closing branches and forcing people onto digital platforms. You can't choose to bank in person if they've closed every branch within 10 miles of your home. And let's talk about those 10 miles. Because geography matters here more than the banks want you to understand. Branch closures aren't random. They're targeted. Over 12 million Americans now live in what we call banking deserts. Places where the nearest bank branch is over 10 miles away. Between 2019 and 2023, that number increased by 760,000 people. But the distribution of that abandonment reveals the logic at work. If you're Native American, there is nearly a 50% chance you live in a banking desert. 50%. That's 12 times the national average. In majority black rural areas, banking deserts grew by almost 3% in just 1 year, compared to 0.3% nationally. This isn't accidental, it's ruthlessly rational. Banks close branches in communities where deposits are small, where loans are harder to underwrite algorithmically, where people are poor, and disproportionately where people are not white. The branches that remain serve wealthier, whiter areas. The concentration of financial power goes hand in hand with a racialized geography of abandonment. Now, you might think, well, it's inconvenient to drive 10 miles, but people adapt, right? Except banking deserts don't just inconvenience you, they trap you in a cascade of economic extraction. When there is no bank nearby, where do you cash your paycheck? Check cashing services that take 3 to 5% off the top. Where do you get a short-term loan when your car breaks down? Payday lenders charging 400% annual interest. Where do you save money? You don't. Because the alternatives to banks don't offer savings accounts. They only extract. And here's the mechanism that makes this permanent. Once one bank closes in an underserved area, the remaining banks face higher costs per customer, making those branches next on the chopping block. It's a death spiral. Right now, there are over 3,000 areas that are one bank closure away from becoming deserts. The cascade is built into the system. But it's not just individuals who suffer. Small businesses, the ones that actually employ people in your town, are getting strangled by this consolidation. Community banks used to provide the majority of small business loans. They could do this because they operated on relationship lending. Your local banker knew you, knew your business, knew the local market. They could assess credit risk that doesn't show up in an algorithm. Personal character, family reputation, understanding of seasonal cash flows in a farming community or a tourist town. When those community banks disappear, that knowledge disappears with them. The big banks don't do relationship lending at scale. They do algorithmic underwriting. And if your small business doesn't fit their model, if you're too small, too new, in the wrong zip code, in the wrong industry, you don't get the loan. The numbers bear this out. Community bank small business loans have fallen from 24% of their portfolios to just 12% over the last 20 years. And when a quarter of bank branches close within a 3-mile radius of small businesses, employment at those businesses drops by 2% within 3 years, 4% within 5 years. The bank closures don't just affect banking, they kill jobs. Now here's where it gets even more perverse. You'd think credit unions, member-owned, non-profit institutions, would be the good guys in this story, right? Local ownership, community focus, all of that. Except credit unions are accelerating the consolidation, not stopping it. Last year, credit unions acquired a record 22 banks, including the 2 largest credit union bank deals ever recorded. They paid cash. And they could afford to pay more than any competing bank bidder, because credit unions don't pay taxes. Think about the logic here. A community bank struggles with rising costs and narrow margins. A credit union swoops in with an all-cash offer funded by tax-exempt profits. The bank's board, acting rationally, takes the offer. The bank disappears from the tax rolls. The credit union grows larger and more powerful. And because credit unions aren't subject to the same regulatory scrutiny as banks when they acquire other institutions, this happens faster and with less oversight. The result? Another institution exits, concentration increases, and the credit union, accountable only to its members, not to the broader public, gains more market power. Let's zoom out for a moment, because this story has been told before in another sector, retail. 40 years ago, American towns had independent hardware stores, bookstores, pharmacies, grocery stores. Then came Walmart. Then came Amazon. The giants undercut prices using scale advantages and access to cheap capital. The independents couldn't compete. They closed. And once the independents were gone, what happened? Prices went back up. Selection narrowed. The town's economic surplus, profit that used to stay local and circulate through the community, got extracted and sent to Bentonville, Arkansas, or Seattle, Washington. The retail giants didn't make things more efficient for you. They made things more efficient for their shareholders by eliminating competition and then exploiting the monopoly power they'd built. Banking consolidation is following the exact same playbook, but it's worse, because credit is infrastructure, not commerce. When you lose your local bookstore, you can still get books online. When you lose your local bank, you lose access to the financial system that lets you start a business, buy a home, smooth out income shocks, build wealth. Credit is not optional in a modern economy. And when 5 banks control half the profits and set the terms for who gets credit and at what price, they control who gets to participate in the economy at all. The banks and their defenders will tell you the regulators are on top of this. They'll point to toughened merger approval processes, longer review timelines, more scrutiny. And it's true. In 2024, federal regulators did make noise about being tougher on bank mergers. But here's what actually happened. 99 bank merger deals were announced through October 2024, compared to 98 for all of 2023. Deal values tripled. The scrutiny didn't stop consolidation. It just extended approval timelines. And that extension itself favors the giants. Small banks considering a merger can't afford to wait 18 months for regulatory approval while paying lawyers and dealing with uncertainty. Large banks can. They have armies of compliance staff. They have relationships with regulators. They have the resources to navigate a drawn-out process. So the toughened rules function as a sorting mechanism. They filter out all but the largest, best-resourced institutions. The result is regulatory theater that creates the appearance of oversight while ensuring that only the biggest players can successfully complete deals. Now let's talk about the efficiency lie, because this one is central to the whole justification for what's happening. Banks tell you that closing branches saves money, and those savings get passed on to you through lower fees or better interest rates. They tell you technology makes banking cheaper and more convenient. They're extracting efficiency gains from innovation, and everyone benefits, right? Except, if that were true, you'd expect to see lower costs and better service. Instead, you're paying higher interest rates at big banks than you would at community banks. You're getting lower interest on your deposits. You are living in a banking desert if you're poor or rural or not white. Where exactly are the efficiency gains going? They're going to shareholders. They're going to executives. They're showing up as record profits for the 5 banks at the top. The efficiency is real, but it's labor efficiency, not service efficiency. The banks are cutting expensive human workers and physical infrastructure. They are forcing you onto cheaper digital platforms, and they are pocketing the difference. When banks talk about technology enabling them to serve customers better, what they mean is technology enables them to serve customers with fewer employees at lower cost, and they keep the savings. Here's the tell. When banks lend to their most profitable customers, small and medium businesses, they still emphasize high-touch, in-person, relationship-driven service. They use technology for compliance and loan servicing, not for customer acquisition. Why? Because relationship lending is more profitable when the customer is valuable enough. The technology story is for everyone else. For you, for poor communities, for small borrowers who aren't worth the cost of a human interaction. And what about the Community Reinvestment Act? This was supposed to be the safeguard, right? Banks have a legal obligation to serve the communities where they take deposits. They can't just redline poor neighborhoods. Except they figured out how to game this too. They sponsor Little League teams. They run financial literacy seminars. They fund a scholarship here, a community center there. All of that counts toward CRA compliance. Meanwhile, actual lending, small business loans, mortgages, personal credit, declines in exactly the areas where banks are closing branches. The banks meet their legal obligations through symbolic gestures, while systematically withdrawing capital from the communities they're supposed to serve. Now, I want to steelman the other side for a moment, because there is a free market defense of what's happening, and you should hear it. The defense goes like this. Customers are choosing digital banking. Branches are expensive and underutilized. Small banks can't achieve the scale economies necessary to compete. When they merge or get acquired, that's just the market optimizing. Larger banks can deliver services at lower cost because of their scale. Nobody's being forced to do anything. This is just competition working the way it's supposed to work. Inefficient firms exit, efficient firms grow, and consumers benefit from lower prices and better service. That sounds reasonable, doesn't it? Except it only works if you ignore every single piece of evidence about what's actually happening. If large banks were truly more efficient and passing savings to consumers, you wouldn't see them charging 8 to 10 percentage points more in interest. If customers truly preferred digital banking over in-person service, you wouldn't see 45% of people still banking in person. If branch closures reflected genuine unprofitability rather than profit maximization, you wouldn't see them concentrated in poor and minority communities, while wealthy areas retain full service. The free market defense assumes competition is working. But consolidation eliminates competition. When 5 banks control half the profits, and 12% of one bank controls 12% of all deposits, that's not a competitive market. That's market power. And market power means the banks can charge more, pay less, and provide worse service. Because where else are you going to go? The community bank that used to offer you better terms doesn't exist anymore. Here's what we are actually looking at. We are recreating the exact conditions that caused the 2008 financial crisis. But now it's not a bug, it's a feature. Back then, banks became too big to fail through reckless expansion and deregulation. The crisis hit, taxpayers bailed them out, and everyone said, never again. We'll break them up, we'll regulate them better, we'll make sure this concentration of power can never threaten the whole system again. Except we didn't break them up, we made them bigger. JP Morgan absorbed Bear Stearns and Washington Mutual during the crisis. Bank of America took Merrill Lynch. The mega banks that were too big to fail in 2008 are even bigger now. And every merger that gets approved makes them bigger still. 5 banks earning half of all profits while representing 1/10% of all institutions. That is not a stable system. that is a fragile system designed to extract maximum profit until it breaks. And when it breaks, you will pay for it again. But here's the difference this time. When the next crisis hits, the communities that lost their local banks won't have any financial infrastructure left to rebuild with. The relationship lenders who knew how to assess local credit risk will be gone. The community banks that could channel capital quickly to small businesses will be gone. All that will be left are the giants. The same giants that caused the crisis, that got bailed out, that spent the last 15 years consolidating even more power. And they will decide which communities get credit to recover and which communities don't. So what do? First, break up the mega banks. If an institution controls more than 10% of deposits or poses systemic risk, it's too big. Break it up. Not through gentle regulation or stern oversight, through forced divestiture. Second, provide targeted capital support to community banks, especially those serving rural areas and communities of color. Make it profitable to stay small and local. Third, enforce meaningful geographic access requirements. If you want to operate as a bank in America, you have to actually serve Americans, all of them, not just the profitable ones. And fourth, end the tax exemption for credit unions that acquire banks and compete head-to-head with tax-paying institutions. But more fundamentally, we need to recognize that banking is infrastructure, not just commerce. Credit is how people start businesses, buy homes, weather emergencies, build wealth across generations. When you let 5 institutions control who gets credit and at what price, you are not just creating market concentration. You are creating a choke point on economic opportunity itself. You are deciding that some communities matter and others don't. That some people deserve access to capital and others deserve payday lenders. Watch what happens next. Watch which communities lose their last bank branch. Watch whether regulators approve the next wave of mega mergers or finally enforce anti-concentration rules. Watch whether anyone in power is willing to name what this actually is. Not innovation, not efficiency, not consumer preference, but theft. The systematic extraction of wealth from your community and the concentration of financial power in fewer and fewer hands. And ask yourself this. When they've finished consolidating, when 5 banks becomes 4, becomes 3, when every small town in America is a banking desert, and every dollar you borrow costs you 10% more than it should, who exactly is this system built to serve?